Welcome to today's Explainer. Look, we need to talk about a financial lie we've all been swallowing since childhood. Seriously, think about it. How many times have you been told that certain types of debt are just a normal, necessary rite of passage, while others are absolute financial poison? It's so universally accepted that we literally never stop to question it. Well, today, we're diving into the hard data together. We are tearing down a massive financial myth that has likely been quietly bleeding your wallet dry, and we're replacing it with a surprisingly simple mathematical truth. Get ready to completely rethink how you look at your money.
All right, so let's start right at the beginning. What exactly makes debt good or bad? Pay attention to your immediate instinct right now. We all grew up hearing the exact same traditional blueprint for financial responsibility. You know the feeling, right? The crushing guilt and anxiety of carrying a balance on a credit card versus that overwhelming pride of signing a 30-year mortgage. One makes you feel like a failure, and the other makes you feel like you finally made it. But the fundamental question we really need to ask ourselves today is, where did that blueprint actually come from? And honestly, much more importantly, does it actually hold up to basic math?
You see this traditional advice everywhere. On one hand, you've got a house, the ultimate, undisputed heavyweight champion of good debt, the classic mortgage. On the other hand, a flat-screen TV, the ultimate symbol of reckless, bad debt. And yeah, that TV probably loses half its value the literal second you put it in the back of your car. According to this old framework, the actual physical item you purchase completely dictates whether the debt is noble or terrible. A house is an asset, so going into debt for it gets this big societal seal of approval. A TV depreciates rapidly, so financing it, financial sin. Car loans are somewhere in the middle, student loans are kind of a messy gray area, but the item itself always dictates the label.
Okay, let's try a little experiment. I want you to wipe the slate entirely clean. Just forget everything you think you know about good debt and bad debt. Because that old logic, judging the debt by the physical item sitting in your living room or the diploma hanging on your wall, it completely ignores financial reality once you actually look at the numbers. Look, it's a really comfortable psychological crutch. It is so easy to categorize the world into noble assets and frivolous toys, which is exactly why this myth is so incredibly sticky. But it's actually a terrible financial strategy because it distracts us from the single metric that actually impacts our wealth.
Let's get into Section 1. Introducing the line.
Okay, let's dive into this. We are replacing that dusty old framework with a single, highly disruptive concept that is going to permanently change how you view your loans, your credit cards, the whole shebang. It's the exact same framework the wealthy use, and it is beautifully, brutally objective. We call it the line. The definition is simple. The line is the interest rate on your debt compared to the return you could earn by investing that exact same money. That's it. That's the entire framework. We're stripping away all the emotion. We don't care if you bought a house, a college education, or a pair of designer shoes. We are purely looking at opportunity cost. What is this money costing you to borrow versus what could that money be doing for you if you put it to work in the market? This mathematical comparison is where reality actually lives.
Let's see how this actually plays out in the real world. Think about debt that sits above the line. We're talking credit cards at 21.5%, payday loans at over 300%, or a personal loan at 14%. If your debt's interest rate is higher than what your money could earn in investments, it sits up here. This is draining your wealth way faster than you can build it. Take that 300% payday loan. The compounding math on that is just devastating. It's a mathematical black hole. But then, consider the other side, below the line, a fixed mortgage at 3.5%, or maybe a subsidized student loan at 4%. If your debt's rate is lower than your potential investment return, you're essentially borrowing cheap money. You can deploy your capital somewhere else that earns a higher return and just quietly pocket the difference. That isn't reckless at all. That is incredibly strategic.
So, you're probably wondering, right, where exactly does this magical invisible line actually sit? Well, while it's not a rigid concrete wall, there is a very clear benchmark you absolutely need to memorize: 8%. For a savvy investor, this number is not arbitrary. Generally speaking, if you look at a broadly diversified index fund tracking the S&P 500, it historically averages an annual return somewhere in the 7 to 10% range over the long term, even after accounting for inflation and dividends. So 8% becomes your magic number. Above 8%, your debt is almost certainly costing you more than you could predictably earn by investing. It's a wealth destroyer. But below 8%, wow, that's when carrying debt actually becomes a fascinating strategic conversation.
Now, as I mentioned, 8% is an amazing rule of thumb, but it isn't set in stone. There are a few specific, real-world variables that can nudge your personal line up or down. Market conditions obviously fluctuate year by year. Your specific investor type matters too. Like, are you ultra-conservative, only buying low-yield bonds? Or are you heavily allocated into aggressive growth funds? And crucially, your tax situation plays a massive role. Think about it. Mortgage interest is often tax deductible. So a 5% mortgage rate might actually act more like a 3.5% or 4% rate once you factor in those tax savings, pushing it even further below your line. But even with these variables, the core concept always holds firm. Are you paying more in interest than you could be earning in returns?
Moving right along to Section 2, a costly reality check.
Let's take this out of theory and put it into practice. We're going to walk through a quick case study right now to prove exactly why the old good versus bad item model completely falls apart. Honestly, this is a costly reality check that traps millions of well-meaning people. Imagine you took out a personal loan at 14% to pay for a professional certification course. Society absolutely applauds you for this. You're investing in yourself. You're upskilling. It sounds incredibly noble, right? Classic good debt. Meanwhile, your neighbor goes out and gets a mortgage at 3.5% to buy a house in a stagnant neighborhood where property values are barely moving at all. Buying a mediocre house might seem foolish, but according to the old rules, a mortgage is still universally stamped as good debt.
So I'm going to pose this question directly to you. Between the noble self-education loan and the stagnant house mortgage, who actually has the better financial position? Take a second. Base your answer entirely on the new framework of the line that we just talked about.
The answer is the neighbor with the mortgage. And honestly, they are winning by a mile. I know, it feels completely unfair, doesn't it? It goes against everything we were taught to feel. You took the initiative. You sought out self-improvement. It feels like the education should automatically be the better financial move, but the math is utterly unsentimental. The neighbor is in a vastly superior financial position, regardless of how noble or socially acceptable that certification course was.
Now, what's really interesting when you map out the math here is the massive opportunity cost at play. That 14% personal loan is a guaranteed, non-negotiable drain on your wealth every single year. It sits way high above the historical 10% average of the S&P 500. You are essentially losing 4% net every year just by carrying it. But consider that 3.5% mortgage. Because 3.5% is so far below that 10% historical market return, your neighbor has a huge advantage. They're actually better off not rushing to pay down that mortgage. By making the minimum payments and investing their extra cash into the market, they're strategically capturing the spread, that 6.5% difference, and using it to relentlessly build their wealth.
Which brings us to our final takeaway in Section 3. The rate is everything. So the crucial point we're making here is this. The old rules are dead. We absolutely have to stop emotionally attaching the virtue of our debt to the physical item we brought home from the store. We've arrived at our final, undeniable mathematical truth. I really want to emphasize this core quote straight from our source material. Let this sink in. The purchase is irrelevant. The rate is everything. That is the entire paradigm shift right there. The very next time you're considering financing anything, I don't want you to think about whether a financial guru would approve of the item itself. I want you to look strictly at the interest rate, look at the historical return of the stock market, and ask yourself which side of the line you're landing on. Are you draining your wealth, or are you strategically leveraging it?
And I'm going to leave you with this final provocative thought for today's explainer. When you log into your accounts and look at your bank statements tomorrow morning, I want you to run the math. Look past the car, look past the house or the degree. What is currently sitting above your 8% line, just quietly draining your future? And much more importantly, what are you going to do about it? Math doesn't care about society's labels, and neither should you. Thanks for joining me today, and I